Hey everyone, and welcome. Today we are going to talk about one of the absolute best tools for building wealth over the long haul, exchange-traded funds, or as you know them, ETFs. We're going to break down how you can use just a handful of these to build a really solid long-term investment portfolio. So let's get right into it. If you've ever felt totally overwhelmed by the thousands and thousands of investment options out there, you are definitely not alone. It can seriously feel like you're trying to navigate a giant, complicated maze with no map. Well, the whole point of this explainer is to give you that map, a clear, simple way to think about putting together your financial future. All right, first things first. Every strong building needs a rock-solid foundation, right? Well, in investing, that foundation is your core. This is the reliable, diversified base that's going to make up most of your portfolio. This is where it all starts. So let's meet a couple of the heavy hitters, VOO and VTI. Think of VOO as owning a small piece of the 500 biggest, most important companies in the U.S. We're talking Apple, Microsoft, Amazon, the big guys. VTI, though, it goes even wider. It includes those 500 plus thousands of other mid-sized and small companies. So here's the key difference. VOO is really a bet on America's corporate giants, while VTI is a bet on the entire U.S. economy, top to bottom. Now, let's talk about something super important. Costs. And get this, both of these amazing foundational ETFs have an expense ratio of just 0.03%. That is dirt cheap. I mean, to put that in perspective, for every $10,000 you have invested, you are only paying about $3 a year in fees. That's it. This lets your money actually work for you, not for some fund manager. Now, if you pop the hood on the U.S. market today, you'll notice something really interesting. Even in a super broad fund like VOO, there's a huge concentration in information technology. We're talking around 35%. Now, that's not necessarily a good or bad thing, but it is so important to understand that a massive chunk of your diversified fund is riding on how well the tech sector does. Okay, so VOO and VTI, they are fantastic for growth, no question. But the dividends they pay out, pretty small. So what if your goal isn't just growth, but actually generating regular income from your investments? Well, don't worry, there's a core option for that too. And that brings us to SCHD. This one builds a completely different kind of foundation. The choice here is really clear. VOO and VTI are all about growing the value of your investment, what we call capital appreciation. SCHD, on the other hand, is built specifically with companies that consistently pen out their profits to shareholders in the form of dividends. So it's a shift from just pure growth to a mix of growth and income. And here is the kicker. SCHD's dividend yield is currently sitting around 3.8%. Now, compare that to VOO, which is only about 1.1%. That is a massive difference, especially if you're trying to create a passive income stream from your portfolio. So what's actually inside this thing? Well, SCHD holds about 100 stocks, and they're all carefully picked for their quality and their history of paying dividends. And notice the difference in what kinds of companies are in there. It's heavy on more traditional, stable sectors like industrials and healthcare, and has way less exposure to tech. This usually means a much smoother ride with less wild swings than the broader market, which is just perfect for a stable, income-focused core. Okay, so our solid foundation is in place. Now, it's time to add a little firepower. This is what we call the satellite part of the portfolio. Smaller, more targeted bets designed to really accelerate that growth. But you have to remember, with higher potential reward, there's always higher risk. And for that, meet QQQ. This ETF tracks the 100 largest non-financial companies on the NASDAQ. And as the slide says, it's pretty much the most direct way you can invest in the absolute titans of technology and innovation. The companies that are really defining our future. And honestly, the performance really speaks for itself. Over the last 5 years, QQQ has given investors an annualized return of about 18%, just beating out the S&P 500's already awesome 16%. Now, that extra 2% a year might not sound like a lot, but trust me, over the long term, that compounds into a huge difference. But, and this is a really big but, here's the reality check. That amazing performance comes with way more volatility. In a rough year for tech like 2022, QQQ fell by about a third. That's a huge drop. And this is exactly why it's a satellite and not your core. You have to be able to stomach these kinds of massive swings to get those potential rewards. All right, now let's get even more specialized. If QQQ is like a broad bet on big tech, you can get even more focused by investing in what are called thematic ETFs. These are hyper-focused funds that are trying to capture the growth of one specific and hopefully revolutionary new trend. Here are a couple of really cool examples. BOTZ invests in companies that are building the future of artificial intelligence and robotics. Then you have QTUM, which takes it a step further into the pretty mind-bending world of quantum computing. These aren't just bets on companies, they are straight-up bets on game-changing technologies. I mean, just look at this number for a second. QTUM, the quantum computing ETF, has delivered a jaw-dropping 5-year annualized return of around 27%. That kind of performance is almost hard to believe. It's the kind of thing that can turn a small, speculative bet into a massive winner if you got in early. But you knew this was coming, right? A return like that only comes with extreme risk. The tech is brand new. A lot of the companies aren't even profitable yet, and their stock prices can swing like crazy. This is the very definition of a high-risk, high-reward moonshot investment. So we have our stable core and we have our high-growth satellites. How do we actually put them all together into one single strategy that makes sense? Well, that's what this final part is all about. This slide lays out the game plan perfectly. It's so simple, but it's powerful. First, you build your foundation. Put the majority of your money, let's say 70 to 80%, into those core ETFs, like VOO or SCHD. Second, you add your accelerators, putting the rest into satellites like QQQ. And finally, and this is key, you rebalance every so often, which just means you sell a little of what went up and buy a little of what went down to get back to your original percentages. That keeps your risk level right where you want it. And here it is, everything we've talked about side by side. This is your cheat sheet. You can really see the trade-offs here. Your core funds, VOO, VTI, and SCHD, they have low costs and pretty moderate risk. Then, as you move over to the satellite funds like QQQ, BOTZ, and QTUM, you can see the potential returns, the risk, and sometimes the costs all go way up. This table helps you understand what job each of these ETFs can do in your portfolio. When you really think about it, every investment you make is a vote of confidence in a certain version of the future. So, are you betting on the steady, continued growth of the whole economy? Or the total dominance of big tech? Or maybe a complete revolution from some brand new technology? Combining these ETFs lets you build a portfolio that reflects your own unique answer to that question. So, what future are you building for?